Hey, what's up, good people? Welcome back to Stock Up with Larry Jones. For those of you that are new, hit the like, subscribe, and the notification bell. All right, good family, let's get the likes up on this one. Sometimes they go low, sometimes they go high. Let's get some consistency. It only takes a second. Anything I say is not a suggestion for you to buy, hold, or sell. And lastly, I don't have a WhatsApp, Telegram. I don't invest anyone's money, okay? I'm just a guy on here on YouTube discussing what's happening with CPI, Consumer Price Index, the Fed releasing of the minutes. Are we going into a recession or not? We're just going to cover a lot of things. Let's get right into it. Now, firstly, I want to talk about, I want to go over something that Jeremy Siegel, who's a professor from the Wharton School of Business, said about what's coming. We're going to dissect what he said, which aligns exactly what I believe. He's always the smartest guy in the room. And then we'll get to the Fed minutes.
Jeremy Siegel, who is back with us, and we're so glad to have you, Professor, on this day. You said a couple of weeks ago, quote, "I can't be optimistic until the Fed, shall we say, gets it, and there's no sign they do yet." How do you feel hearing these comments that we've gotten today and what you might hear in the days ahead?
Yeah, I believe the Fed has already done too much. I voiced that for the last 6 months, that the trajectory was way too high. By the way, speaking about the core, if you actually put real shelter prices in, from Apartment List, Zillow, or the Case-Shiller number, I've done the calculation. Core has been zero inflation for the last 4 to 5 months. So it really wipes out the core if you use real shelter prices instead of the, as we know, dramatically lagged prices that the Fed is using. So really, core is not a problem. They should have stopped. They shouldn't have raised last time. It looks like they're going to raise again and make an announcement of a pause. I really hope Austin Goolsbee makes a dissent, because there has not been a dissent for over a year at the Fed. Groupthink has reigned, I think, to the detriment of monetary policy and the American economy. And I would like to see another voice actually make a dissent at the meeting. So I am awaiting that.
Professor, if they raise in a few weeks' time, what happens to stocks?
Well, I think it depends. We still have, 3 weeks to go of data. I really think, again, what happened to the banking system and what I see in data on lending falling off the cliff really portends a much bigger decline in economic activity. I am shocked that no one at the Fed has actually cited the reduction in lending that has occurred almost the most in 75 years, actually. We know M2 liquidity last year fell by the most in 85 years. It's falling again this year. The squeeze on liquidity is much greater, believe it or not, on the money supply than we even saw during 2007, 2008. Now, I'm not claiming we're going to have that, because that froze the entire banking system. But what we saw with SVB and the lending standards, I think the Fed should absolutely not raise. What does this mean? The probability of recession has gone up. Listen, I said for the last 2 months, I'm not really.
Yeah, so I agree with him. Probability of recession is going up. The Fed is reading late data, as much as 4 to 6 months behind. So he's behind. Remember, we wanted him to pull off the Band-Aid and just go, higher, 50 basis points, 75 basis points. Had he did that earlier, the market would have been more stable. But he's saying the same thing I'm saying, that you see a recession coming. Now, I'm the only one standing along still. Everybody's like, Fed's not going to pivot. He's not going to pivot. He will pivot. Fed will go. The Fed will force us into a recession, but that's not a bad thing, because what happens is when we go into a recession, This sets us up to win, good people, because he will start to reverse his interest rates. When the Fed start reversing the interest rates, then the market takes off again, all right? And so I agree wholeheartedly with Jeremy Siegel. I came to this conclusion, and I am, I can't pay taxes on his smartness. Yes, I said smartness, intelligence, okay, smartness. And but he lays it out. You know what? Let's look at some of the numbers, all right? Let's look at some of the CPI inflation numbers. As we can see, Consumer Price Index month over month was 0.1 versus 0.2 estimate, right? CPI ex food and energy was 0.4 versus 0.4, so it was right there. CPI year over year was 5 versus 5.1, and CPI month over month was 0.1 versus 0.2, right? So there we are. With the consumer price index, the market actually reacted positively at opening bell. But what else happened today? We had the release of the minutes, okay? And there's something very interesting in the releasing of the minutes, and I want you guys to check that out. Just before we go over that and discuss that, I want you guys to make sure that you download the second link below and get up to 15 free stock with Moo. They have a ton of stuff. Of course, I don't want to go into it. Look at some of the stock that you could get. See, Amazon, Ford, Tesla, all of that. And it's depending on your deposit amount. And lastly, the top link is Stock Up You. You want to earn more, learn more. Take my class, and you also see that I have myself. I do the beginners. We got charting with stocks with Josh, who is killing it, telling us when to buy, when to get out, options. There will be 2 more options lessons released next week, dividend investing, and we also have basic fundamentals. Okay, make sure you check out the top 3 links below. Right, let's get right back into it. Let's see what the Fed minutes release.
Minutes to the Federal Reserve's meeting in March show that the staff says the effects of the banking turmoil would likely lead to a mild recession later this year. It sought a recovery from that recession in 2024 and 2025. The staff had previously seen the recession as a possible alternative to its baseline forecast. Now it seems to have elevated that to the baseline forecast. The staff expects inflation to step down markedly this year and slow sharply next year. We usually don't begin with staff, but this is a pretty big change right now in the forecast for the staff. It says the forecast is tied to the banking conditions, which are uncertain. It also says the Fed officials themselves in the meeting saw banking turmoil likely leading to tighter credit conditions, and it saw banking turmoil likely weighing on growth, jobs, and inflation. The outcome of these banking failures and stresses to the banking system were seen as uncertain during the meeting. The banking problems were seen as limited by most participants, however, and they did factor into policy, and they would factor into policy, they said, if they affect jobs, inflation, and growth. Some officials would have hiked 50 basis points if not for the banking stresses, and in the absence of the banking stresses, Fed officials would have raised the outlook for the funds rate as well. And it caused them to lower their outlook for the future funds rate. Economic risks were weighted to the downside, inflation risk weighted to the upside. One more thing here. Participants also saw the labor market as very tight. Wages were slowing only gradually, and inflation was seen as unacceptably high.
Inflation, unacceptably high. Labor market, is tightening. We got tightening in credit. It's going to be more costly for businesses to borrow money from the bank. There's a credit squeeze. There's a lot going on with the market long term. And as you can see, we have short-term gains, right? We can make short-term plays. Some of you played the Qs today. If you made a play and made some money today, let me know how that worked out for you. But I'm just going to tell you right now, there's 2 times when it's dangerous to be trading. To me, one of them is CPI. Now, I made money on CPI based on me doing a ton of research on a specific stock or company, but it is when CPI comes out because the market needs time to digest it. So let's look at where we are now, literally 40 minutes before closing bell. Now you can see everything is down. The Dow, S&P, and NASDAQ, as he was making the announcement just about an hour ago, we were green, right? And so the Fed minutes saying soft recession is, I could just tell you guys, that's like, the boy coming to a girl saying, hey, let's get it on, baby. And she go, oh, I might get pregnant. And he goes, well, you may get a little pregnant. So how can you say soft recession? You don't know how deep the recession is. But I still believe that the Fed will still go up 25 basis points. He may not. This is not written in stone. It's not 100%. But he still may go up 25 basis points. At this point, the market is not going to really like it because everybody wants him to put on brakes now, which he should. I agree with Jeremy Siegel, Professor Jeremy Siegel, and he's reading lagging core. He's reading late data, okay? And he's reacting off of late data. Let me know if you agree with Jeremy Siegel and myself, and that there is more likely that a recession may come. But that's not bad news, because if and when the Fed starts reducing its interest rates, the market will rebound and start to take off. All right? We're going to leave it right there. Live, love, laugh, learn, and earn. Be kind, rewind, do it again.